Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so looking at our market today, we have closed only ever so slightly lower. We did try to push down throughout the day, but we saw a little bit of buying come back up. Now, at this point of time, we are holding a key level of resistance as support around this 71.30 level. If this level's taken out, we'll reconfirm a bit of a double bottom and confirm a inverse head and shoulders pattern, in which both of those patterns for me sort of indicate that we're going to see a move back up near the all-time high. Now, look, I'm not overly optimistic of that happening at this point of time. I still feel the markets are probably a bit overdone to the upside, actually, and may pull back a touch. Maybe not back to the lows where we saw before, but a move back to at least 68, I think, is back on the table. If not, down here near the 7,000 level, I think this looks a bit overdone, this rally for me. But in saying that, there's definitely some upward pressure in this market. We could see as high as 73 in the near term as well. Now, coming across to the US market, they're not quite as overbought as what we are, but that was one hell of a move last week, guys. Okay, one big move. And really, in one session, 5.5% is kind of unheard of, right? Something doesn't happen very often at all. So to the downside, 5%, yeah. Upside, no, not really. Okay. So, but at this point in time, guys, look, there's still some room to resistance, and those stochastics are heavily pointing up. So our momentum's definitely up, and we are seeing targets of around 40.60, which is the 200-day average, and then the downtrend line that comes in roughly around 40.88 as well. I think we'll slowly climb towards those levels in the coming week, in which then we'll probably find that'll be the short-term top, and a pullback will come shortly after. The seasonal pattern that we normally see around this time of year, if we see a strong November, we typically pull back early December, in which then that sets up for another rally into Christmas. So I do think we'll see a reasonable pullback at some point between now and sort of that second week of December. There's a lot coming for us in that second week of December, guys. We've got the next CPI announcement from the US, not to mention the next Fed announcement, and that will be the next major challenge for markets. Okay, so is this the end of inflation, right? So we saw CPI reading last week come in a little bit lower than expected. If you look at the chart of CPI, it looks like it could be peaking. So this could be the top, but warnings from the Fed and a lot of Fed officials over the last week are still suggesting there's a long road ahead to bring inflation back down near 2%. And what that means is they're going to use their tools of what they have to use to bring inflation down as quickly as they can. Okay, so what we're looking for there is inflation potentially coming back down in a couple of years' time, not as quickly as what people think, right? And so I think there's still some warnings there from the Fed, and I think they're still fairly negative for markets. Markets are pricing in a much slower pace of rates going up from here. Rates have definitely not topped for me. I think we'll see rates continually go up until about middle of next year. The rate at which they'll raise rates will slow down. Right? Obviously, 75 points is a bit excessive, a bit crazy. It's time to tame that down a little bit. 0.5% is probably on the table for December, and then coming into next year, we'll probably see consecutive 0.25% rises right through to the middle of the year, which is still going to take rates as much higher than what the markets are currently pricing. Okay, so we saw a big pullback in the bond yield space. US 10-year came back down from 4.2, 4.3 down the 3.8. I think it landed about 3.88 this morning. I think that's not really representative of what's to come. Okay, and what's happened in the bond space really is that the longer term maturities came down quite a bit. Shorter term maturities, though, have remained high, which has caused the yield curve to invert further. Therefore, that's once again a big sign of recession next year for the US. So that's kind of where it leaves us at the moment. Is we're going to have some form of recession in the US next year. How hard a landing are they going to go for to bring inflation down is the question. And that still is the narrative somewhere in the background. Even though in the short term here things have turned a bit more positive, longer term there's still this risk to markets, and I think that will keep things a little bit subdued in the medium term. But as I said earlier, short term things are looking a little bit on the bullish side. China stimulus is definitely helping, right? Especially our market. So materials have held our market up recently. Banks have been fairly sideways after that rally. Okay, in the last 2 weeks, it's been more the materials that have been pushing our market higher. So that's all on the back of talk of, slightly relaxed restrictions for COVID. I don't believe that. I don't think they're really doing much on the COVID front, to be honest. But what they are going to do is help stimulate their local construction industries, and that's why you're starting to see some industrial stocks like, BlueScope, Sims Metals rise strongly. We've seen our materials sector take off, and I don't blame it. Iron ore's back to yearly highs. And then you've also got the likes of things like copper that have taken a decent rally in the last week as well. So, a lot of your metals and things have performed really well since the talk of Chinese stimulus. So that's kind of helped, like I said, really boosting our market up. But a lot of these sectors are looking a bit exhausted. They're looking a bit overbought in the short term here. So, and this is why I keep increasingly think that there's probably not much more left in this rally before a pullback has to happen. We need to see some profit taking. And then, the election didn't quite go as what people were expecting. We're still guessing on who's going to win the Senate, and we're going to have to probably wait out till early December before we're going to get the results for that. So, we're going to be waiting a while. And this is where, for me, a lot of information's being kicked out until early December. So between now and then, look, we could easily see a lot of sideways whippy type behavior. Okay, and that's what we're going to be waiting to see, whether we're going to break higher. Is this it? Is this the bottom for markets, or are we just going to really whipsaw around with as the news flows? Right. For me, this is still the most uncertainty we've seen in a long time. This inflation issue could continue for a lot longer than what we want it to. So even though in the short term here things are looking a little bit more optimistic than what they were, I still don't think we've seen the end of the volatility. So just be wary, and in particular, be very, very careful around any CPI readings and Fed meetings. And we'll just keep an eye on how that data flows. The last GDP reading in the US was decent. So we're not seeing that sign of recession just yet. So yeah, we could see a reasonable rally into Christmas this year. But I do feel a pullback is on the table first. That's the typical seasonal pattern around that time of year. We get a pullback early December, push into Christmas. Okay. So yeah, right now for me, this is a trading market. Investing side of things, I'm still keeping some powder dry. Yes, we'll be happy to buy some cheap stocks around here, but just being very, very cautious in doing that and the timing of that. From a trading perspective, it's week by week, and happy to adjust views and strategies accordingly as we get more and more information on whether CPI, or I should say inflation, has actually topped out, and whether we will see the Fed back off or not come December and February. All right, so that's probably the main things to be watching, guys. Bond yields are the key. All right, US dollar index is the key. Dollar index up, yields up means market down. Okay, that tells you your mood. Okay, for equities. So dollar index, US dollar index up. I'll say that again, bond yields going up. It tends to lead the market down. All right, so they're my bellwethers right now for the overall market sentiment. And then we're seeing these little themes start cracking off at the moment, like gold, because on the back of the crypto crash. We're seeing commodities rise because of the Chinese stimulus. And then, obviously the larger of the themes, which is the interest rates and inflation story. We saw today lithium stocks get hammered, so there's a little bit of a theme there at the moment. So we're looking for these little micro themes playing out, okay, at the moment, where we've got the big sort of bigger view, big macro view of what's happening in the whole interest rates inflation story, but they're looking for these other little sector views as the weeks roll on. Okay. All right. So leave it there. Thanks for listening in today. Take care and bye for now.